My name is John Prado, and I'm honored to be Canada's Consul General in the greatest city in the world, New York City. And I welcome you to Canada's official residence here in New York City. Je vous souhaite tous le bienvenue ici ce soir. Je suis très ravi de vous voir. Et je suis certain que ça va être une soirée très, très intéressante. Part of our mission here at the consulate is to provide thought-provoking discussion about Canada-US relations and to promote and advocate and strengthen Canada's message here in New York. And tonight is no exception. Tonight I'm absolutely thrilled to be hosting Gluskin, Sheff, and particularly David Rosenberg, who I consider one of the most outstanding economists in the world. He's read by everyone in the investment community, including myself, and I had the honor of meeting him today, so it was quite a thrill. Today, Canada stands at a very interesting time, and I'm very fortunate to be representing Canada at this particular time in our history. We've got a pretty sound economy, with its challenges, but very solid. And I'm reminded today in an interview that I was just watching on CNBC between Maria Bartiromo. You saw it, Hillary, as well? She was interviewing John Chambers, Chairman and CEO of Cisco, an incredible American company and a CEO that's been there for quite considerable length of time. And he, on the program, not provoked in any way, said that Canada, and particularly Prime Minister Stephen Harper, who he mentioned, has done it right in terms of enticing capital and businesses to expand. So tonight, we're going to have a good discussion from David on the compelling case for Canada. And it's also a great time for you to meet David and the rest of the Gluskin Sheff team that will be introduced shortly, and understand what their philosophy is on global investing and Canada itself. So I welcome you again to Canada's official residence. To the people that are here for the first time, a big welcome. To people who have come here, we welcome you again.
It's great to be here, and as Jeremy said, you know, we're coming up 6th Avenue last night, and we passed by the Merrill building, and it hit me that it's been 4 years that I've been with the firm. And exactly 4 years ago, when the press statement went out that I was, you know, leaving and coming back, coming back home, I was getting inundated with emails saying, "Hey Rosie," because that's my nickname, not Rosie Scenario, just Rosie. "How do I get my Canadian green card too?" And I said, "No, dudes, I'm Canadian, just coming back home." It's interesting that you know, nobody knew that I was Canadian. And when I got the job as the chief North American economist, you know, working in New York, I always got you know, questions about the U.S., questions about Russia, questions about China, Brazil, places I didn't know. And I was the chief North American economist, but I never really got a lot of questions about Canada. And when I think back about it, I really should, because Canada was a real gem, but really off the radar screen. And when I take a look at what's happening around the world, and we're out of this, still in this aftermath of this global credit collapse, I realize that you read the Rogoff-Reinhardt masterpiece, you read the McKinsey report on what happens after a global financial crisis, you end up living in what's called a fat tail world, where the range of outcomes is extremely wide. There's thin tail and there's fat tail. And when you can analyze the markets and the economy in the context of a fat tail distribution, that the range of outcomes is as wide as they've been in my lifetime, then when we're building the pyramid for investments for our clients, the bottom of the pyramid is in a fat tail world, you have to be fully diversified. Not a time to take on concentrated bets that you have in a thin tail when we actually have a certain level of a comfort zone. And it's not just about asset classes, but it's about currencies. Because the one thing I realized all the time in the US, and what I realized today, is that out of all the countries in the world where investors have a real home bias, it's Americans. And investing outside the home country is never an easy decision to make, but always in the name of wealth management, how do you end up creating alpha without adding too much beta? And when I speak to, and I've spoken to American investors about when you take money outside the country, what comes to mind? It's always sort of like, you know, Fidelity's emerging market fund. Without people realizing, just north of the border, there's actually a lower risk way to play the emerging market world through commodities. and through a more stable currency, and through a neighbor to the north, you know, that you should know. So the most important decision that anybody's going to make investing outside their home country is the currency. And then the question becomes, are you going to invest in a currency that you can rely on, or a currency that's going to have pitfalls? And what's really remarkable, and something I wasn't paying enough attention to because I was only focused on the US for the most part, even though I was the chief North American economist for Merrill Lynch. And I realized this after working at Gluskin Sheff for the past several years, that if we're taking a big picture, it's rather remarkable that when you take a look at the Canadian, say, equity market landscape, there's more than one market, let's look at the equity market landscape, that the Canadian equity market over, say, a full 10-year period has outperformed the US stock market by 100 percentage points, which is rather incredible. Now, part of that was just the composition of the Canadian equity market. You have about, call it 35% or 40% that's in stable financials. No Canadian bank went under, no Canadian bank went cap in hand to the government, no Canadian bank cut its dividend. I think the world knows a lot more about Canada now than it did, say, 4 or 5 years ago during the height of the financial collapse. And then, of course, you got 50%, which is resources, which are hard assets in the ground, proven and probable reserves. Believe it or not, as lucrative as that composition is in your equity market in terms of sector composition, for example, because Canada has tripled the resource exposure that the US market has, and the Canadian banks, say, pay double the dividend yield that the US banks do. 60% of that differential between what the Canadian market delivered and the US market delivered, 60% of that delta, or that differential, came down to the Canadian dollar. The Canadian dollar, from the depths of despair in 2008, 2009, has gone up roughly 20%. And if you're going to ask me, say, in the next number of years, and I'll say number because I don't know if it's 3, 4, or 5, I wouldn't be surprised if the Canadian dollar ends up going up, I would say at least another 20%. You know, I talked before about fat tail, thin tail. You know, I work in an industry, you know, as an economist, a strategist, you have to forecast. And I realized that the forecast is always just your base case scenario without ruling anything out. You know, in a fat tail world, some forecasts you have 40% conviction in, and then there's other forecasts you might have an 80% conviction in. You know, so when people say, well, this forecaster was wrong, and that economist was right, and he was wrong, and he was right, it's not about being right or wrong. It's just basically that you have a base case scenario. It's never 100%, but it's your base case scenario. Some have 40% probabilities, some have 80%. And the one conviction that I do have is that the Canadian dollar is going to be a very reliable currency to add return to an American investor's portfolio for the foreseeable future until the facts on the ground change. Now, what are the facts on the ground? Well, one fact on the ground, for example, is the relative political dynamic. We just got a political result in the United States. You know, I'm looking at it as an observer from Canada that both parties spent $6 billion to get the same result that they had 24 hours earlier. So I find that fascinating because my next door neighbor's got a beautiful black lab, and if I really wanted to take a chair, sit down and watch him chase his tail, I'd happily do that for free. But in America, we spent a lot of money to get the same result. And yet the same result is still filled with uncertainty. Like we basically have the last 2 years and we don't know how the president's going to react. We don't know how the House Republicans are going to react. There's still a lot of uncertainty, whether it's the fiscal cliff, but we still have a political quagmire in the US. And I looked at Canada, and it's interesting because it's very difficult to model statistically what the political backdrop really means when you're doing, say, estimations for valuation among securities or asset classes or the currency. But there has to be something that's important, because in Canada, 2006, Stephen Harper, who would feel very comfortable with a Margaret Thatcher or Ronald Reagan, if you don't know who he is, he's the Prime Minister of Canada, got elected in 2006, He had 2 minority governments because we have a parliamentary system. Parliamentary system, you have a minority, you got to do horse trading, you know, with the other parties, not unlike the checks and balances you have in the U.S. But in the Canadian context, last year, the Conservative government won a majority, which is huge. I mean, you're talking about Canada, which historically prided itself on Trudeau mania and socialist policies. How Canada swung to the right is incredible. That we would have elected last year a right-of-center majority Conservative government. What we know in the U.S. is we have another at least 2 years till the next midterm election. We have more political uncertainty. In Canada, at least we can sink our teeth into that at least for the next 3 years, we're going to have a pro-business, pro-capital government in Ottawa. And I like to fancy myself as a bit of a historian. And when I take a look, only 15% of the time, historically, has Canada been governed by a Conservative majority government. And this is not some paid political announcement. It's just trying to help people add returns to their portfolio, especially as we're here seeing prospects and clients in the U.S. This has only happened 15% of the time. It's pretty rare. And the Canadian dollar, during these periods, when you have a pro-business government with a majority where they can actually get legislation through without bargaining, the Canadian dollar is more prone to a bull market than it is to a bear market. Well, that's nice to know for at least the next 3 years. What else? Well, what about monetary policy? Now we're guaranteed to have Bernanke, at least till 2014. And make no mistake, there is going to be more balance sheet expansion because as we go through, and if it's not the fiscal cliff, there is fiscal drag coming in the U.S. It's going to weigh on the economy. And Bernanke believes he's the only game in town, and believe me, so will his successor. That means more balance sheet expansion. That means that the supply of U.S. dollars in the foreign exchange market is going to continue to rise relative, maybe not relative to the euro, and maybe not even relative to the Japanese yen, but certainly relative to the Canadian dollar, because the Bank of Canada under Mark Carney is certainly not undertaking any money printing or balance sheet expansion. So you've got the government policy over here, you've got the monetary policy over here, and I come from the background of the fixed income market. I ultimately learned about the equity market, the commodity market, but my background when I started in the business was in the fixed income market, and I always adhered to the rule that the bond market usually gets it right. And if you're watching the bond market for the past couple of years, we have a very interesting dynamic where, if you take a look at the front end of the Canada curve and the US curve, say 2-year bond yields. Right now in Canada, 2-year bond yields are 80 basis points above where they are in the US, at the very short end of the yield curve. What does the short end of the yield curve tell you? It tells you something about relative economic strength, and it tells you about how monetary policy is positioned. And that's one of the reasons why you're probably surprised why when commodity prices came down because China slowed down the problems in Europe this year, the Canadian dollar hardly buckled. And that's because if you're, say, a Bill Gross or you're a Larry Fink and you're looking at the bond markets and you're looking for relative value, well, you're going to continue to put money in the front end of the Canada curve because you're picking up at least 80 basis points over what you get in the US. But what's interesting is that even as Canada has that 80 basis point positive spread at the short end, the 30-year Canada bond yield is actually 40 basis points below where it is in the US. This is so unusual if you're following the markets to have this pivot where short-term rates are higher than the US because of the economy. And rates at the very long end of the curve in Canada are lower. And what does the 30-year bond of any country tell you? It tells you 2 things. It tells you about fiscal risks, and it tells you about inflation risks. And that's what the 30 years is telling you. Canada does not have a fiscal cliff to fall off of. Now, we may get hurt like everybody else will if we get a fiscal cliff in the United States, which I'm not so sure that we're going to see. But you see, Canada has a 1% deficit GDP ratio, and the U.S. is over 7%. We never had to bail out the banks. And we never really had to bail out the economy. It wasn't as if there wasn't some stimulus. It's just that we never really shot ourselves in the foot on fiscal policy. The U.S. has a 70% debt GDP ratio at the federal level. Canada is basically 30%. So you're talking about what are the fiscal risks? How does that play into the long-term trend in the currency?